How's it, guys? This video is going to be about fair value gaps. Specifically, what is a fair value gap, what is a BISI, and what is a SIBI, what is a consequence encroachment, what is an inversion fair value gap, and the difference between a fair value gap, a volume imbalance, and a gap. First of all, what is a fair value gap? A fair value gap is a three consecutive candle pattern whereby the first candle's low does not overlap with the third candle's high, or the first candle's high do not overlap with the third candle's low. If you take this low and extend it further to this side, we realize that there's a space in between whereby the third candle's high do not go into the first candle's low, and the space in between them makes what is known as a fair value gap. Similarly here, if you take the first candle's high does not overlap with the third candle's low, if you extend the first candle's high, no, don't. Okay, similarly with the bullish fair value gap, the first candle's high do not overlap with the third candle's low. So if you extend this high to this side, you realize that the low of the third candle does not go anywhere near the high of the first candle. So the space in between them makes a fair value gap. Okay, now that we know what a fair value gap is, let's talk about what is not a fair value gap. Okay, if we were to extend this low to here and extend this high to here, in this instance you realize that the first candle's low does overlap with the third candle's high, because the first candle's low is here and the third candle's high is here, so no fair value gap exists here. Similarly with the bullish fair value gap, if you extend this high to here and extend this low to here, now if you move, you realize that the first candle's high does overlap with the third candle's low. So similarly in this instance, a fair value gap does not exist. Okay, now that we know what a fair value gap is and what's not a fair value gap, let's look at what is a SIBI and what is a BISI. A SIBI simply means sell side imbalance, buy side inefficiency. What this means is that sell side was offered but buy side was not offered here. Similarly with the BISI is buy side imbalance and sell side inefficiency. What this means is buy side was offered but sell side was not offered, right? Okay, guys, now that you know what's a fair value gap and what's not a fair value gap and the difference between a SIBI and a BISI, let's look how market react to both of these. In a SIBI, we have a situation where we have a market going down, creating a lower low. Then we expect the market to come into the SIBI, and the SIBI will act as resistance to keep the market below the 50% of the fair value gap and pushes the market down, right? Similarly, with a bullish fair value gap or a BC, the market is going up, creates a higher high, then we expect the market to come back into the BC, and the BC will act as support to push the market up, right? If you are wondering what this line in between the fair value gap is, this is what it's known as a consequence encroachment. A consequence encroachment simply means 50% of the fair value gap. How you get this is you take your fib and you put your fib to the high of the fair value gap and to the low of the fair value gap, then the 0.5% of the fair value gap is what is known as a consequence encroachment, right? Now that we know the first instance of how SIBI can influence the market, let's look at the second one. The second one is when the SIBI act as an inversion fair value gap. What is an inversion fair value gap? An inversion fair value gap is when we have the market coming here, making a lower low, coming into the fair value gap, instead of closing below the consequence encroachment or the 0.5% of the CB, the market closes above the CB or the or the fair value gap. Then we expect the market to come into the CB and into a 0.5% of the CB. Then the CB will act as a support to push the market up. This is what is known as an inversion fair value gap. Similarly, with the BISI, we have the same situation. We have the market going from here, going up, creating a higher high, and instead of this creating support for the market to go up, the market closes below the CB. Then we expect the market to come back into the CB, the 0.5% of the CB, or even the opening, whichever one you prefer. Then this acts as a resistance to push the market further down. Okay, the next thing that we are going to talk about is the difference between a fair value gap, a volume imbalance, and a gap. We already discussed what a fair value gap is. We know a fair value gap is when the low of the first candle does not overlap with the high of the third candle. Most importantly is that it's a 3 consecutive candle pattern. 3 candles, 1, 2, 3. With the volume imbalance, we only have 2 candles, and it's a situation whereby the body or the close of the first candle does not overlap with the open of the second candle. The wicks do overlap, but the bodies do not overlap, so it creates a volume imbalance. Right? This one is a 2 candlestick patterns. Right? Then with the third example, the gap. A gap is when there's a complete gap in between 2 candles, where you have the low of the candle or the close and the low of the first candle, which does not overlap with the high or the open of the second candle. That creates a gap. A gap. Now that we understand the difference between fair value gap, volume imbalance, and a gap, and we know what the fair value gap is and how to trade it, and what's an inversion fair value gap and a BC, let's go to the market and look at a few examples. Okay, guys, for our first example, we're going to use US 100 on the daily time frame. What are we looking for? We're looking for a 3 consecutive candle pattern whereby the low of the first candle does not overlap with the high of the third candle in a BC, or whereby the first candle's high does not overlap with the third candle's low in a BC. Right? Let's go. We have this break of structure here. We have this break of structure to the downside. And if you look at this, we have a fair value gap here. We have a fair value gap because the first candle's high, the first candle's low, the first candle's low does not overlap with the third candle's high. So the space in between this, between the space between this low and this high is what is known as a fair value gap. We have a fair value gap. If you look up a bit closer, you realize that we also have a volume imbalance. What is a volume imbalance? A volume imbalance is when the close of the first candle does not overlap with the open of the second candle. A volume imbalance is a 2 candlestick pattern whereby the close of the first candle does not overlap with the open of the second candle. The 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 wicks may overlap, but the bodies do not overlap, so we have a volume imbalance here. So in this instance, what do we expect the market to do? We expect the market to come into the fair value gap, either 50% of it or into the volume imbalance before going down. Let's see what price did. The price went into the fair value gap here. Now we're gonna see a price moving down to attack these lows. These lows were taken, but remember, this volume imbalance also have to be rebalanced. So price at some point in the future will come back into this fair value gap before going further down, or will come back and close above it and use it as an inversion volume imbalance. We have price tapping into the volume imbalance here. Now we expect the market to go down and attack the lows. Yeah, we expect the market to come back to these lows. These lows were taken here. These lows were taken here. Now that, guys, now that you understand, we know what a volume imbalance is and a fair value gap. A fair value gap is a three candlestick pattern whereby the first candle's low does not overlap with the third candle's high, right? And a volume imbalance is a two consecutive candles pattern whereby the close of the first candle does not overlap with the open of the third, the second candle, right? Let's look at a gap. A gap is when there is none whatsoever. There are no candles overlapping or wicks overlapping between two candles. A two consecutive candle pattern whereby the low of the first candle does not overlap with the high of the second candle, and the close of the first candle does not overlap with the open of the second candle. So there's a complete gap where the market left space. Here you can check here from this close to this open. It's a complete space. There's no candle here, there's no candle body, and there's no wick. So this makes a gap. Right? Thank you for watching, guys. If you have made it this far into the video, please consider subscribing and liking this video. Till next time.